welcome everyone. We are back with our Gatewood Wealth Solutions weekly market commentary broadcast. And this is John Gatewood. And with me today is our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
John, I'm glad to be here. Another week.
It's another week, and it was an interesting week because we saw the market decline right after we had that call about raising cash.
Yes.
Very timely that we did that.
As well as taking the convertible position out of the fixed income and going to the Barclays Ag and adding portfolio insurance.
So let's dive right into the timeline in terms of where we are relative to our forecast for the economy and the coronavirus.
Well, it's exciting. We finally changed the timeline. We now have a new green square in there, a rectangle, which was the industrial activity rebounding by the fourth quarter. We'll look at some slides on that. It is based on lagging indicators, so we still are a little, I guess the word would be cautiously optimistic, or the phrase. Probably more cautious than optimistic in the short term. But continue to move through that timeline. We still have U.S. continues to rise in 2021 as that onshoring accelerates. One of the themes that we've been talking about, and we will get to in today's call as well.
So what about the coronavirus? Where are we with that? Because we were expecting some increase, right? Because we have Labor Day and people out together.
If we get an increase from that, it should be a couple of weeks out. There's an incubation period, and then you have to go get testing. We did see a significant drop yesterday on those cases, but we've seen that that kind of sawtooth pattern where at the end of the week we do get a drop. It's an extended weekend, so it's not surprising to see a drop. So we're really not going to know for a few days whether there was how substantial the drop is. But we won't see any effect from Labor Day for a week or so, I would say, in the numbers. But we continue on that downward trend. I would anticipate that we would see that downward trend in cases continue to decline. And we're now consistently below 1,000 on the daily average for deaths. That trend continues to decrease, and I expect to see a continuation where each day is below 1,000. It's been a little while since we've seen that, but we expect that. And because we're starting to see lower death counts per week, we're starting to look forward and look at some of the unintended consequences or things that would come about for the lockdown that are getting more attention.
Well, I know there was the CDC director who spoke about the number of suicides, especially among teens or people, I guess, from grammar school through high school.
Right. This is a conversation that he was having, and we really weren't able to get any of the hard facts of the material that he's referencing. To get that interpretation is certainly something that you're taking out of context, because what's not very clear is, does he mean that the week over week deaths versus suicide and coronavirus, now the suicide deaths are higher? Is he specifically talking about the young people, because it was in the context of going back to school, so it seems it needs to be a high school. But nonetheless, we are beginning to see that drop in daily cases, as well as to start seeing some unintended consequences or things that will come out of that lockdown component.
Yeah, well, so one of the things that we get questions about is, how does coronavirus death compare to other illnesses? And especially because we had talked about in the last couple of weeks about how 6% of the coronavirus deaths are actually due to the coronavirus itself.
Alone.
No
comorbidities.
Where the other 94% has 2.6 comorbidities on an average. So maybe you can address that.
Right. So these numbers, except the red number, the 2020 COVID-19 deaths, are all 2018 numbers. It takes a while for them to actually compile and get the list, but this is the top 10 deaths in 2018, and we can see that heart disease was the highest amount of attributable deaths at 655,000, followed by cancer at 600,000. So in comparison, based on CDC numbers, there is that lag as they come about. As it takes time to process death certificates. We're at about 175,000. So relative to 2018, the coronavirus death would be the third highest or leading cause of death. But then there's going to be some complications in those numbers. One, there are a lot of people that are missing their cancer screenings. So we would expect to see an increase in cancer deaths because many people are not getting ahead of that and being screened and finding it before it becomes life-threatening. So we do anticipate cancer deaths increasing. Heart disease, I don't know that the screenings are going to cause any increase there where we're not catching it in time. But there's probably some cannibalization because many of the coronavirus deaths, as you talked about, had 2.6 on average comorbidities, some of which were heart disease. So we're not exactly sure whether that's going to be increased because of lack of screening or decreased because some of those deaths were ultimately determined as a coronavirus death, that tipping point. Things that will probably be cannibalized in the number is accidents. So that's the closest number as in comparison. So there's 167,000 deaths in 2018 attributed to accidents. I would guess that number will be lower for 2020 because we're not driving as much.
Right.
There's a lot of areas that are not going to see the fatality rate that we did in 2020. But then there are other areas such as the lower respiratory disease, diabetes, influenza, and pneumonia. All of those are getting classified, or some of those are getting classified as coronavirus deaths, so it wouldn't be surprising to see those drop down. And then suicide, that's the one we expect to actually see an increase. And this is not just a shutdown, but we see this during typical recessions. Unemployment goes up, people's despair goes up, and then you'll see an increase in suicides. Well, there's also the isolation effect, and the unemployment has certainly been well above a normal recession this year, so we do anticipate seeing a higher suicide rate. But once again, we don't have the actual details of the CDC director's comments to really put that into perspective.
I think that an important number is that 6%. So if we take the 6% of the 174, we know that's a smaller number than what's reported in the paper, just because the CDC doesn't get the numbers reported in their final form until after everything is in and verified. But, so 6% of that number is a much smaller number than even the suicides when we look at it. So really, just as a virus alone for the healthy person, it's a very low risk of death. But there's a high risk, of course, for people that have that comorbidity, and that's where...
And a lot of those are also in those influenza pneumonia numbers, typically, which is 60,000. So if you were in that high risk, there's certainly a higher propensity or a higher risk of fatality due to that virus as well. Absolutely.
So let's talk about the election, because of course that's in the news. We're getting closer and closer. In fact, I was in Washington, D.C. last week, and I saw that the Black Lives Matter Plaza is right in front of my father's office building that he was in for years and years when he was working there.
So the election, we talked about the Republican and Democrat National Convention and that bump, and we talked about how the President Trump seemed to have benefit. More as we look at this more, it seems that it really has a lot to do with him running as a law and order candidate, at least effectively, whenever it comes to the perception, because those his polls were rising, or the betting odds is what we're looking at here, but the polls are the same, where that was appreciating all the way up to the convention. I don't think it would be coincidental that his numbers are dropping during a week where we have a lot of volatility as well. And then I think everyone is familiar with this week's theme on the election.
Oh, yes.
Which is the vote by mail. I don't know what to call it. Just contention.
Right.
What's the word that I'm looking for there?
Well, there's whether or not the vote by mail is something that should be done because of the potential for voter fraud. So maybe let's talk a little bit about that today.
Right. I think one of the ways to approach this is just can we find common ground with majority of the people? I would say 99% of the people would agree with this, that people have a right to vote in a free and fair election, and that's part of a basic civil right. Many of our rights do come out of that. I think we can get bipartisan agreement on that, as well as the Congress and the states should guarantee that every eligible individual, I think there's people would debate on what that criteria for eligibility is, but that if you are eligible, you should have a guarantee to be able to vote, and no one's vote is diluted or stolen. And then where the contention is voter fraud. We would say that voter fraud is real, and there are hundreds of convictions have been made and documented.
So let's talk about, so what types of fraud does that really relate to?
Right, there are a few different things legally whenever we look at that on the type. So they're in existence. Impersonation and fraud at the polls, so somebody coming up and saying that they're this person at this address and that they're really not there. False registrations, duplicate votings. Now, duplicate votings are the area where you're talking about mail-in ballots and absentee ballots, where somebody would vote their mail-in vote and then go to the polls and vote. And that does happen. In Georgia, they were talking about, they had discovered about 1,000 incidents where somebody voted on an absentee ballot and went to the polls and voted that day. And then there's another component is that fraudulent of absentee ballots. Buying votes, some politicians, this is usually not an individual, but a politician, certainly there are examples of that. Illegal assistance at the polls. So John, in my 20s, I think they offered $150 a day, which was pretty good money back.
Pretty good for you today, too.
It's good money today, too. Where you would go in, and one of the things you had to be very careful of when somebody asked you for help is that you didn't somehow assist them or even influence them or possibly with body language maybe intimidate them, because there's always a Republican and a Democrat. You don't know who you're working with. So you had to be very careful on how you helped somebody and approached somebody. So it doesn't even have to be intentional.
Well, I think the issue is there's certainly the potential for voter fraud, but it's more the how do you assure that a mail-in ballot is actually from the person who is on the form that is that eligible voter with that guaranteed right?
Well, there will be some signatures involved, and they will compare those signatures. There's also the voting rolls, but I think the signature is the best example. One thing, though, that brings up, and it's not that it's not solvable. I think we could solve it if we were to try to really approach this and set those goals that we were looking up at first. But you have to sign that thing, and then they compare your signature. Well, if you're signing the ballot, that's kind of going against the idea of a secret ballot, because then there is some type of indication on how you voted. But just to kind of get back to that vote by mail, to demonstrate, no, that there is some risk in vote by mail. It's not as secure as going to the polls. We had in 2019 the North Carolina District 9, where they found the Republicans were, or at least accused, and probably correctly accused, of voter fraud, where 60% of the vote by mail that came in were for Republican tickets, yet only 16% of the requests were from registered Republicans. So that kind of tipped the...
Didn't realize it had so many switch.
Right. So we do have a redo election. The previous Republican candidate will not be allowed to run. So this is an example of some fraud in the vote by mail, because it is a little bit more susceptible. We also have an example from this year where mail voting redo in New Jersey, and this is the Wall Street Journal. The courts found that it was not fair and that it was not a free election, and that there was that the expression or the intent of the voter was disregarded. And the way they found this out was there was about 25% of rejections of the vote by mail, where typically there's 10%, which gives you an idea of how not great, I guess, the system is, right? If you have 10% rejected, are we disenfranchising people unintentionally by the vote by mail?
Right.
So there's certainly examples, and there may be pushback, because they'll say, well, yeah, but the point is that it's rare. And there's really no study that is referenced whenever it's rare, so we don't know exactly what that means. Are you looking at the overall voting population and finding, well, hey, this incident was small? Well, it can still be a small incident and actually have a big impact, especially when you're talking about presidential elections.
Right. I mean, I think the one thing is that this is not a new phenomenon.
Right.
And when people are bringing up this concern about the mail-in votes and the potential for fraud, it's that the fraud is going to happen. Somebody's going to.
It's as old as voting itself, right?
But is this increasing that possibility of having it even greater? So let's talk about what happened in Florida.
Right. So even if it is small, right? We had a single county in Florida in 2000. This was I could vote for in 1996, Dole and Clinton, but this is the one that I most remember as the earliest voting.
Like Gore and Bush.
Gore and Bush, where a single county had to be recounted several times, and we had to get into the hanging chads, what is the voter intent, and this held up the presidential election. Just one small example. Gore had easily won the popular vote, but it all came down to this process with the electoral vote that this became an issue. So we think it's not an accurate statement to say that it's false to be concerned about voter fraud. And if we're going to do our best for this clip. If it doesn't play on the sound, then we'll kind of summarize it. But this is 2008. So it's been 8 years since that 2000 example, and the Democrats are concerned that they will lose the election because of voter fraud. So this is, at the time, candidate Barack Obama, soon to be President Barack Obama, answering a concern from the audience. So,
I would just like to know what you can say to reassure us that this election will not be rigged or stolen.
Well, I tell you what, it helps in Ohio that we got Democrats in charge of the machines. But look, I come from Chicago, so I want to be honest. It's not as if it's just Republicans who have monkeyed around with elections in the past. Sometimes Democrats have too.
So one thing as I was listening to this as we prepare for the talk was, wow, what a difference it was back in 2008 on just the candidate selection, right? It seems like a very reasoned and adult response.
Right, we had actually had adult conversations back then. What's happening now?
Yes, I don't know what's happening. But the Democrats were, at that time, rightfully concerned about voter fraud. So juxtapose that today where they're saying, well, there's no such thing, it's not true.
Right.
And we just go back to history and say, well, this probably has a lot more to do with politics than it does the actual risks.
Well, so the issue now then, Aaron, is that given the fact that we are going to have mail-in voting, what's the likelihood that we're actually going to know who was elected president if it's a close race? And how will the markets react? And what are we going to do with our portfolios?
I think our listeners are more concerned not with what we feel as who's actually making a true statement or not, but to your very point, how is the market going to respond? And there was an organization that used game theory to try to play that out. And we're starting to see that in the news with, they're referring to it as the red mirage. Well, if we have a large percentage of Democrats that are going to participate in the mail-in ballots, and it's going to be a delayed process. I've seen where they assume 40% of Democrat voters will use the mail-in option. And Republicans will predominantly be at the polls, and you get those numbers first, is on election night, it'll look as if Trump has had a landslide victory based on those results. But knowing the mail-in ballots have not been counted, there will be no concession. So we'll be back to 2000. And I would say the current environment today versus 2000 is far more risky whenever we're looking at whether people have integrity and trust in the electoral system. So that's going to be a big issue if we get into past election night and we really don't have an idea of who has won. And what is that going to do to the market?
So we haven't really experienced that yet, but what would be your understanding of what may happen or how the markets might react and what we might do as a result?
Well, we would expect the market would be very volatile and we would have sell-offs, and those betting odds are going to move all over the place on who is being positioned, whether through politics or just basic vote counting. It will be uncertain. So we would think that there's going to be a lot of whipsaw action until there is clarity around the election, as well as a very real potential for people to lose faith or distrust the outcome just because of the rhetoric that's going to bounce back and forth in an environment that we all realize is already pretty tense with the amount of riots and the accusations that are already going back and forth.
So how would we prepare our clients in terms of how to manage through this? Because that means if there's a risk of their portfolios going down in value, they could spike up in value. So what should they be thinking about right now in terms of preparing themselves for
It's going to
that?
be really hard to tell on exactly how that's going to happen. So it's basically just trying to buckle up, know that this volatility is coming as we approach and we have a better understanding of what sectors would do better for the other. We'll start to look at, well, how do we position the portfolios given that this volatility, or how do we take advantage of it? One of the things that we have in the portfolio now is portfolio insurance. There are probably things that we can do to help dampen that volatility and maybe even take advantage of some buying opportunities through that time or that chaos that would.
So let's talk about the economy. How are we doing now?
So we continue to climb out of that deep hole, but if we look here, we can see that the early on, the slope of the line was pretty much like a moonshot. And as we look out over the last 5 to 10 weeks, we're really seeing that that slope change. So it's not the big jump. So we are a little bit concerned about some of the things that we're seeing going forward, but we still had a positive growth rate. It's just not nearly as high on the change as it was before. And then if we look at, we referenced this at the beginning, the manufacturing index, one of the last areas to begin to see progress or rebounding. We're not in the fourth quarter yet, and we definitely see a rebound happening in manufacturing. Then when we look at unemployment, which may or may not be easily to see on the screen, we continue to drop. We're at 8.4%. That is progress, but there's a lot of noise and a lot of uncertainty under there. The further we go, the more likely it is that those that have been furloughed are not going to go back to those positions. They're going to have to start looking for jobs. And though 8.4 may look like a great number, we got to remember it's 2020. That means it's a year of a census, and there's a lot of temporary employment by the federal government as they begin to hire people for the census. So just because these numbers are going the correct way, one, they're lagging numbers, and two, there's a lot more to it than just these base numbers that we're looking at.
So there's still a lot to look forward to in terms of understanding where the market's going to be with a lot of uncertainty.
Yes, yes.
So where does that leave us in terms of our themes? I know we've been talking about being U.S. focused and
Right, so we
tell us
talked
more.
about inflation risks as being high, and one of the reasons that we favor equities is because of that inflation risk. We'll get into the on fixed income maybe next week, but we wanted to talk about why we favor U.S. domestic markets. For those that are looking at this screen, don't try to understand it. This is a what's known as a Cobb-Douglas function on how you determine what GDP growth is for an economy. And the point that I want to illustrate is there's really just two levers with this. It's that labor participation. The more people that are in the workforce, the more growth you'll see in the economy. And the other component would be technology, that's that K. And the better or higher up your technology is, the more productive the labor force will be. So that all of these factors will drive up a higher growth rate. And the U.S. is certainly dominant whenever it comes to technology growth. They are still the leader in the world. And it may surprise many, because we've talked about demographics as a whole in the world, and I'm sure many people have heard that the birth rate or the fertility rate has been declining. But because of immigration and relative to other countries, the U.S. actually has a very strong profile on its demographics.
Well, speaking of birth rates declining, China is a country that is in severe decline.
Yes.
For birth rates.
For birth rates, right. They had the one-child policy, which not only limited the size of the families, they often favored males, so then there's not as many females, and females are critical to the fertility rate, right? So then let's look at that slope that you were mentioning on China. If we go back to 1984 all the way up to present, they had a very robust growth in population, and they also had a very robust growth in their economy. That's probably not coincidental. Actually, the equation that we just looked at says it's not as part of it. If we look down to the United States, we can see certainly not as a large of population, but it continues to have the same trend going upward within the population growth. India will actually surpass China this decade.
What impact do you think that may have on the global economic outlook, just with India as an economic power?
Well, they need to work on some of their institutions being a little bit more free market. China actually did, though they labeled themselves communist, they had a lot of reform. I can't remember the exact saying, but it was basically saying they're not concerned about the color of the cat. Can the cat catch a mouse? Which means they weren't concerned on whether they were truly following communist policies or capitalist policies. They just wanted to grow an economy, so they made a lot of changes. They still have an authoritarian component, but for their economy, they did free it up relative to where they were before. India still has a lot of reform to go through on that component, and their capital base or their technology, if the U.S. doesn't invest heavily in them like they did China or the global capital centers, then they probably won't have the capital that China did.
Understanding this population distinction between the different countries is important, because that actually follows a theme with one of the institutes that we follow, the Institute for Trend Research,
yes.
ITR, and what this may mean in terms of where economic activity is going to be or even not be in the future. So let's talk about that.
Right, so the way that you look at it is, let's take the U.S. And China, and let's add some triangles. So what's happening is the younger percentage, so under 20 in 2035 will be 35.9%. And then 20s to 39s, part of that Generation Z and some of the millennials will be 26%, and Gen X would be 29%, with the baby boomers, John, you retiring by 2030.
By 2030
would be smaller, but the triangle has a bigger base, meaning that labor participation, the further we go on, we have more people going into the labor markets, and even the under 20s, those families that are supporting them, that's part of that consumption. They're investing. That's all helping to grow the economy. Where we look at China, well, they're going the other way. So as time goes on, their population ages and removes themselves from the workforce, so that'll detract against the growth of the economy. And then if we look at the major economies now, we can see that India, as you were talking about, certainly has good demographics. They need to work on that K part of the equation for sure. Germany has and most of Europe looks like an inverted triangle, so they're going to struggle. Mexico it has great demographics. They have a lot of reform that's been put into place, and they're really close to the U.S., so we could have some synergy there with just being able to trade, and Mexico would be our biggest trading partner, so that would be advantageous for the U.S. Brazil, Japan's really the poster child for this inverted
right. I mean,
triangle.
It looks like Japan is going to be shrinking very rapidly.
Yes,
because
it's a very aged society, and a lot of people are not retiring, and they're looking at automation and different mechanical components that those that are working to help extend that. So it's not. The demographics could change with technology, but for the most part, the U.S. is really favored. Now, we haven't gotten into the currency component as the U.S. dollar has been declining. That makes labor in the U.S. Less expensive, so that can actually increase economic activity. But with that component, there is a trade-off, which means a lower standard of living relative to other laborers out in the market. So basically, the U.S. is getting paid less for their labor. See the economic activity, but at the cost of giving up some standard of living to see that economic activity. And then if we just look at the U.S., because it's not, I don't want to paint a completely rosy picture and not acknowledge that there still are issues with the U.S. We look at 2020, 56 million individuals are 65 and older and are collecting entitlements. That's going to jump to 73 million. Now we still see a larger numbers below them at 104, 93, and 84 million in 2030. But that growth rate was not near as high as the entitlement growth rate in the 65.
Right. So the question is, what type of impact will that increase in the payment of all those entitlements to that baby boomer generation that's in retirement? What's that going to do to the economy and to the market?
So there's really three things that can happen. There could be a cut in those benefits, and we've seen that with the change of how they calculate the COLA using that chain CPI factor and how low inflation has been, extending the age that you could start to begin collecting. So we are seeing benefits decrease. As you know, in our modeling, we try to assume 2% below inflation for growth of those to try to factor that in. The other area would be to increase the taxes, but if you look at the voting demographics below them, that's probably not going to go over well for most of the population. So there's probably not going to be great success because of the polls and that the group is larger than the 65 and older. So there'll be some, there's unlikely to be high tax increases to pay for that factor. The other option would be to continue borrowing. We think entitlement spending, and as the baby boomers retire and payroll tax isn't sufficient to cover Social Security anymore, is one of the big reasons that we've seen such a rapid jump in the U.S. deficit, as well as the coronavirus and some of the other issues that we've had 2008. Certainly seeing runaway debt at the moment in the
Well,
U.S.
let's talk about the money supply, because we saw
Right.
a drop in the market last week, this week. Now today we're up a little bit again, but people start getting afraid. So how does that track to the money supply?
Well, if you look at the money supply and we see what's almost a parabola sticking out, we had 60% growth coming out of this pandemic crisis. And that's one of the reasons that we have invested aggressively, added the convertibles to the fixed income, because we anticipated that as that money flow increased substantially relative to the growth that it was, that we would see a major movement in the market. The thing is that amount of money that was created isn't sustainable to continue to grow at that pace. So now that the Fed is starting to step back, we're seeing a decline. And when we started to see this decline in the money supply, that's when we decided to raise 36 months cash for those that would need it in the near term. That's when we decided to take the convertible position, take our 40% gain and move it into the Barclays Ag to help position. And we started to move technology towards that portfolio insurance and try to become more defensive. Now that doesn't mean that we're bearish in the market. And the way that we think about this, or I'm going to do my best to try to explain it, is as that money growth accelerates, so it's the growth, not the money supplied, it's the percentage change. Think of it as a pipe, and it's a pipe that almost expands because so much flow is going through it. So we got 60% flow. Well, once you come back down to 40%, maybe that pipe doesn't expand. You have a lot of air pockets now in there because it's just slowing and we saw that. That's one of the reasons that we put on defensive positions. We think the Fed will act because there really hasn't been much pain from doing so. They will become, they'll at least jawbone and say they're going to increase the money supply. You also may have a new fiscal stimulus. So we are expecting a lot of the data to come in really erratic. So we're not schizophrenic in our investments, and we're just trying to follow the data. And we think there's going to be 3, maybe 4 opportunities where we have nice sales in the market as things come off. So one example would be if we did see that 10% correction in the S&P 500 and we started to see the money supply tick back up and our signal was positive, we may take some of that 36 months and maybe we dial it back down to 24 or 30, depending on the risks of that red Mirage developing and maybe put some of that money back in. But
I guess one of the concerns is when you look at the money supply for this year, it's the steepness
yes.
and within this short period of time that it accelerated so fast, and now it's declining at a rapid rate.
Right, because it accelerated so
right.
fast.
So how do we manage or even think about the market when we see something that's beyond what we've ever had in the past?
Well, one thing is that we're going to be data dependent. We're going to continue to follow our process. Our process does work. It doesn't ring a bell at the top, so whenever we get into these sell-offs, at first we're going to give back more than what the index does, but that's what allowed us to gain more during that thing. But the way that I visualize it, John, is if you had a big lake and you dropped a boulder in that lake, that first initial wave is going to be really high, and then it's going to kind of crest, and then there'll be another wave that's a little high. So it's going to take several cycles for this to start to actually slow down and not have so much of an erratic back and forth. But we actually find this as an opportunity because we are watching this. So few people are watching it, and it certainly has helped signal when to become more defensive. And we would think that that would also signal us to be more aggressive. So we're going to use these opportunities to try to continue to add value to clients' portfolios because it is one of those indicators that we don't think a lot of the market is really paying attention to. So we're taking it as one, buckle up and be prepared for the volatility, but also be prepared to take advantage of it.
So the market was down. Our portfolios have lagged a little bit because of the fact that we have an overweight in the technology, but we did pare that back. Mm-hmm. So talk to us about the market, where we are, and how will we know when to get out if it's a prolonged drop versus getting back in?
So we'll base that off of our relative strength indicators on what's working, what isn't working. There are different components that we're comparing to. If we're looking at a large cap fund, it's compared to the S&P 500. It's also compared to T-bills. So how is it doing relative to cash, just because it's beating the S&P 500? And then we're looking at a couple other technical indicators. All of those are still positive, and they'll probably stay positive for quite some time because of just the massive gain and how high they are. So we look here, one thing that would be negative is if that 50-day, and I know the viewers may not know what I'm talking about, would get below the 200. Well, the 50-day is near 3,300, while the 200 is at 3,000. So before that happens, the average 50-day has to be below 3,000. So it'll take some time because of that. We're going to act a little bit quicker. Our system is geared to adjust for these issues. But I would say the big thing for clients to be aware of is there isn't the bell at the top. And one of the signal is that we have to begin losing relative to these benchmarks before we make the change. So there will be some spread that's given up. But the reason that we're so far ahead is because we followed this process.
And there really was no safe haven this drop, except for cash, of course.
Right. That's one of the things that really is an important thing to talk about, and one that we're looking at is when you have everything selling off, equities, fixed income, gold, all across the board, there's no place to hide. That is confirming that what is happening is the money supply, not something else. So if you go back to the crisis, while the money supply was going up, technology was still doing well while everything else was selling off. Bonds were still doing well. So when you get across the board sale across a market, whenever you get into the theory, that is the telltale sign that this is a money supply correction.
So we've been looking at the dollar, monitoring that because we did have a precipitous drop earlier in the year. How are we doing in that?
So we did have a little bit of a rally through last week, but it was nowhere near the high enough to recover what has been lost since the pre-crisis. And we think this is part of that theme of why we favor U.S. domestic, specifically small and mid cap. So we are watching it. The dollar continues to struggle relative to other currencies, but we did see a kind of a relief rally in the dollar last week. So it's still considered a safe haven.
So how did we do on the relative strength chart? How did the different asset classes do relative to each other?
Last week we talked about how unusual it was, and we ran it a couple of times, but the only thing that was doing well was the technology and commodities above the S&P 500. Last week technology certainly sold off more than the S&P 500, as did commodities. We are watching this indicator. Now, we've seen this happen several times already this year, where technology is selling off and it seems like there's a rotation of value, and we did not just jump on that trying to anticipate what we believe will happen. We're waiting for the signals, and if we would have acted on those, we wouldn't have the significant gains that we do yet. So we're going to continue to wait for those signals to push us out, other than trying to take some of those gains and be a little bit more defensive, where we're using that portfolio insurance or we're filling those cash hubs. So we continue to watch that, but technology certainly was hit hard relative to the other indexes last week.
So we've had some questions from our audience, and one of the questions is, Congress has not passed a stimulus. There is talk. What would you expect if there is a stimulus package versus if there's no stimulus package passed?
So if there is a stimulus package, we would probably have another 2 to 3 months of a market rally. The money supply would again explode and move up because there was a creation of that. But ultimately, that's going to have to be paid for. The other alternative versus a stimulus package and having 3 months, it's just opening the economy. So if we open the economy, banks would then probably loan money out. There would be more certainty, and it'll be a more organic creation, a more lasting creation, because whether we have a stimulus or not, that is just going to be a temporary component. If we do get it, know that we're probably calling our clients with the 36 months of cash, bringing them back down to 24 as that money supply ratchets up, and we'd want to take advantage of that. We'd want to take some of those defensive positions off and get those work back into the market and taking those risks. So I know we sound schizophrenic on this. We keep going back and forth. We're not causing this. Our opinions aren't changing. It's just we're in an environment where the data is so erratic and there's so many moving parts that we're going on and off, risk on, risk off.
Now, so Tesla was on a tear this year, and we just had the change of the S&P 500, but it didn't make the index.
Right.
Now, it did have a drop-off this past week that was bigger than the market drop, but so why didn't that make it into the index?
Well, the S&P 500, a lot of people think it is a pure passive strategy. It's not. They do have quality components that they have to meet, which is earnings. And earnings are something that Tesla has not had consistently. So they didn't make it into the S&P 500. There was speculation on whether the S&P 500 would change that component to try to get it incorporated there. So one, they didn't get the flow that was possible through the reconfiguration of the index, but then also things that are doing really well and more speculative when the money supply is increasing are going to do well. And as we have that, so I think they got hit with a double whammy. With not making it in the index. At the same time, the money supply was shrinking.
Well, then you have a different type of company that's not manufacturing at all. It's
Right.
almost a virtual company, and that's Etsy.
Right, and I think
And that made it in. So what's that all about?
well, they do have a profit. They did make that quality screen, but I think it's really telling of the change that is happening in the environment, because Etsy was brought in, and Kohl's, a retail company, was moved down to a mid-cap company. So this is one of those companies that has networking effect. They're not producing anything. It's known as a place that you can buy in the gig economy for people that are producing their own products. And people will go there, so a lot of customers know to go there. So they've been able to access that networking effect, which seems to be the big driver for companies that are going to be successful in the 21st century. What made companies successful in the 20th century are probably not going to be the companies that are successful in this 21st century.
Now, you were talking about opening up the economy. I was reading in the Wall Street Journal today that the UK is now going to begin to have more restrictions in the economy once again because the cases have been going up. In fact, in Europe, they've been going up a lot. The interesting thing, though, is that hospitalizations have remained almost exactly the same. There's no increase at all, despite this increase in cases. And it said that the average age now of a new case is 31, where back in June it was 52 was the average age. So how do you think the other European nations are going to be reacting now that we see this first mover in starting to close down the economy once again?
Well, I think one thing is that the coronavirus is serious, but the lockdowns have been disastrous for a lot of countries. And that as the death rate drops, especially with the new cases being younger and younger and the risk relative to new cases versus daily deaths, that cost is going to become more apparent. One example that is kind of that counterfactual example, we really have one that did was Sweden, which they were criticized because they did have early on they had higher cases, they had higher deaths, but now since they didn't do a lockdown, since they did not mandate masks, their cases are very few and their economy is growing. So I wouldn't be surprised if some countries start to look at Sweden, though it's been criticized for its platform, of really taking their lumps early on, and they're now through it, where the countries that have done lockdown, Spain is another one, where they have continued to be very tight on the economy, and there's a slower progress and there's a lot of pain. And let's get back to the idea of unemployment, increasing suicide rate, increasing drug use, increasing the chance of you not getting your cancer screenings. So a lot of those costs are beginning to show up. What the politicians will do, it's not uncertain, but there are examples and new information coming on how to respond to the situation.
Well, on a positive note, however, New York City now is going to open up at least 25% in restaurants and bars starting in September 30. So that's actually good news because they've been like a ghost town. It's interesting. I was just in Washington, D.C. last week, and it's amazing how empty the streets are relative just 6 months ago during the workday.
Right.
Now there does seem to be, the restaurants are all pretty full, but you just don't see the cars in the street or the people walking around the way that you would normally do.
Well, New York is an example of the street. They've been using a lot of the street for the restaurants because they were only able to eat outside. And New York doesn't have the greatest climate during the winter, right? So they're going to have to make some change, or there's going to be additional restaurants that go out of business. And it's not to say that New York doesn't have great restaurants. It would be a shame to lose some of these, because that's some of the best restaurants and the best chefs are in that city. And that city has certainly seen a lot of movement out because of that lockdown. So it's a trade-off, and it's not just medical issues, as we've talked about before. There's that culture and that quality of life that why would you live in such a high-cost area that your apartment's the size of a shoebox? Because there's a lot of other things that are great about New York. The opportunity, but also the culture, the theater, the museums, the restaurants, that if New York wants to attract and continue to be that magnet for very high levels of human capital, they're probably going to need to open up to be that. Otherwise, they're going to lose their status, and another city is going to be able to benefit from it.
Well, it looks like we're out of time today, and it's been very, very interesting and enlightening. It's going to be interesting to watch what happens as we get closer to the election.
So one of the things that we could cover real quick before we get off here is, John, how would people get a hold of one of their lead advisors if they have questions or any about needing to take some actions? Or
Yeah, so I think that's a great question. So one of the things is that our lead advisors can be reached here by phone or by email. So if you have a question, they're available to schedule a time for a conference call or in-person meeting. But also those who are just listening in who are not clients. They are fully available, totally complimentary to have a review of your own circumstances. So that would probably be the best to reach out to schedule an initial consultation.
Yes.
But one of the things that we're trying to do is to increase our subscription. So what are the benefits of having a higher subscription?
So right, so if you subscribe to YouTube, one, you can go back and look at how well we've done, because we have months worth of these market updates in real time that you can watch and look back on. If you subscribe, you'll get an alert, so if you do miss one or you want to review some of the call, you'll get that alert by subscribing. Also, it will help the viewership. The higher amount of subscriptions that you have, the better technology YouTube actually offers. Being able to do YouTube Live, being able to do some swipes, so that actually helps us continue to deliver this content in a better format. So absolutely, please go on there. If you're currently listening to it on YouTube right now, right down to the right is the word subscribe, sometimes a bell. Click on that and you'll get an alert every time there's a new video posted.
And we certainly welcome you forwarding an invitation to our future broadcast to your friends and family, because we truly want to be able to share our message to anyone who is interested in trying to live our mission, which is to become and remain financially self-reliant. So thank you very much for listening in today. We look forward to having you again in future broadcasts, and have a very good, prosperous rest of the week. So long for now.